Welcome to the critical intersection of neuroscience and financial success. We often treat investing as a game full of thrilling highs and terrifying lows. But that emotional approach is precisely what separates the perpetually chasing amateur from the consistent, wealthy professional. The inconvenient truth is that your brain is wired for immediate reward, a burst of dopamine triggered by action, volatility, and the thrill of a quick win. This primal craving for excitement, this internal neurological loop, is fundamentally antagonistic to the patient, systematic discipline required for genuine wealth accumulation. Today, we confront this behavioral hazard head-on, understanding why the most successful financial strategy is often the one that feels the most utterly boring. We must learn to divorce the feeling of excitement from the process of making money, acknowledging that short-term stimulus is the enemy of long-term compounding.
The primary mechanism undermining most retail investors is the dopamine feedback loop. When you execute a trade, whether buying or selling, your brain rewards the action itself with a shot of dopamine. If the trade is profitable, the reward is amplified, reinforcing the impulse to trade again, leading to overconfidence and excessive risk-taking. Conversely, a loss triggers cortisol and adrenaline, stress hormones that compel you to act quickly to get even, leading to emotionally driven decisions, often doubling down on poor choices. This chemical cocktail transforms the disciplined pursuit of value into a high-stakes, stressful addiction. Smart investors aren't immune to this biology. They simply understand it and create systems, firewalls, to bypass their own emotional vulnerabilities, treating their portfolio less like a racetrack and more like a carefully managed reservoir.
Consider the common narrative of the day trader: the constant screen time, the rush of intraday volatility, the perpetual search for the next hot stock. While this lifestyle is highly cinematic, the data tells a starkly different story. Academic research consistently shows that over 80% of active fund managers fail to outperform their passive benchmarks over a 10-year period. And for individual retail day traders, the statistics are even more punishing, with up to 95% losing money over the long run. The excitement derived from frequent trading is a cost center, not a profit driver. Every transaction incurs friction, taxes, commissions, and the invisible cost of poor timing. True success in the market isn't about identifying the spectacular outlier, but about consistently participating in the overall, unspectacular growth of global productivity, a principle that requires steadfastness, not quick reflexes.
The antidote to the dopamine trap is the philosophy of legendary long-term investors, most notably Warren Buffett. His strategy is famously simple. We simply attempt to be fearful when others are greedy, and to be greedy only when others are fearful. But perhaps the most powerful aspect of his success is the emphasis on inaction. He famously stated, "Our favorite holding period is forever." This means embracing long periods where literally nothing happens in terms of portfolio decisions. This is not laziness, it is calculated discipline. By making initial, thoroughly researched decisions and then allowing the magic of compounding to work undisturbed, he removes the emotional temptation to tinker. If you are constantly looking for something new and exciting to buy or sell, you are not focused on investing, you are focused on entertainment. And entertainment almost always comes at a high price in the financial markets.
Let's dive into the quiet powerhouse of long-term wealth: compounding interest. The compounding effect is exponential growth, where your returns begin earning returns themselves. But compounding is an inherently boring force. It does not produce noticeable results in weeks or months. It requires years, even decades, to truly accelerate. Imagine a snowball starting small at the top of a huge hill. For the first few revolutions, it barely grows. That is the frustrating, boring initial stage of investing. But as it gains mass and momentum, its size explodes, seemingly effortlessly. Trying to hasten this process by day trading is like trying to push the snowball downhill with short, frantic bursts of energy. You disrupt the natural momentum and risk fracturing the structure. The consistent, patient strategy yields far greater rewards because it allows time, the most crucial variable, to amplify every dollar invested undisturbed.
The ultimate boring investment vehicle is the low-cost index fund. Index funds, such as those tracking the S&P 500 or global markets, embody the principle of diversified passive ownership. They require zero research into individual companies and zero decision-making based on market news. You simply own a tiny slice of the entire economic engine. This strategy is statistically superior for the vast majority of investors because it eliminates the risk of single stock failures and prevents the emotional errors associated with stock picking. When you allocate your capital to an index fund, you are essentially setting up an automatic wealth machine, removing the trigger points for that dopamine rush. This approach forces patience, removes the need to be smarter than the market, and provides the best possible assurance of participating in long-term economic prosperity.
Another essential component of boring success is implementing dollar cost averaging, or DCA. DCA is the mechanical process of investing a fixed amount of money at regular intervals, regardless of market price movements. This practice is the enemy of market timing, which is driven by speculative excitement. When markets are down, your automatic contribution buys more shares. When markets are up, it buys fewer. This systematic approach shields you from the emotionally destructive cycle of trying to buy the dip perfectly or selling before the crash. DCA formalizes the necessary behavioral discipline, turning the investment process into a routine chore, similar to paying a utility bill. The goal here is to automate the good behavior and eliminate the subjective decision point, robbing your brain of the opportunity to inject dopamine-fueled chaos into your long-term plan.
We must recognize the deep psychological biases that make boring investing so difficult. Human beings suffer acutely from loss aversion. The pain of a loss is felt roughly twice as strongly as the pleasure of an equivalent gain. This bias is what triggers panic selling during market downturns, sacrificing long-term assets for the immediate emotional relief of stopping the pain. The dopamine seeker, conditioned to react to rapid movements, is particularly vulnerable. When the market plunges, the boring investor sees discounted assets and simply continues their systematic buying, or ideally, ignores the noise entirely. The excited investor sees panic and potential disaster, selling at the exact worst time. Mastering boring investing is fundamentally mastering your emotional response to volatility, understanding that market dips are a normal, inevitable part of the wealth creation journey, not a personal threat.
To enforce this disciplined boredom, investors should actively seek to create friction between themselves and impulsive trading platforms. This means reducing how often you check your portfolio, perhaps limiting access to once a quarter or even just once a year. Remove the trading app from your phone's home screen, unsubscribe from sensational financial news channels and hot stock email lists designed solely to trigger FOMO and panic. The less information flow, the fewer opportunities for your dopamine circuits to hijack your rational decision-making process. Think of your portfolio management as deep hibernation. Once the initial structure is built, the less you disturb it, the more effective it becomes. True mastery is the ability to ignore the daily fluctuations and maintain absolute conviction in the decades-long growth trajectory.
Ultimately, the excitement you seek in life should be divorced entirely from your investment portfolio. Find your thrills in your career, your hobbies, your family, or creative pursuits. Your investment strategy should be the financial bedrock that supports a life rich with genuine, non-monetary excitement. The true payoff of boring, systematic investing isn't the daily market movement. It is the eventual, quiet realization of financial freedom, the ability to choose how you spend your time and energy, unburdened by debt or financial worry. That silent freedom, the ability to retire comfortably, to fund a child's education, or to weather an economic downturn without stress, is a deeper, far more rewarding neurochemical experience than any fleeting high derived from a successful trade.
In summary, the journey towards substantial wealth is rarely a thrilling sprint. It is a marathon of consistency, patience, and often profound inactivity. To succeed, you must acknowledge the biological fact that your brain is actively trying to sabotage your long-term plans for short-term dopamine hits. The most profitable investors are not those who are market wizards, but those who are masters of their own psychology. Embrace the mundane, prioritize diversification and low costs, automate your contributions, and most importantly, develop the discipline to ignore the noise and let compounding do the heavy lifting, often for years without recognition.
Investment success is less about what you do and more about what you rigorously stop yourself from doing, resisting the urge for that thrilling, costly intervention.
Wealth creation demands delayed gratification, a trait that directly conflicts with modern society's impulse for instant consumption and constant stimulus. Remember, if investing feels exciting, you are likely taking too much risk or trading too frequently. Aim for the quiet certainty of routine. Let your portfolio be the most boring spreadsheet you look at all month, and watch as that boredom transforms into financial security over time. Implement these boring, powerful principles today to ensure your future self thanks your disciplined self. Thank you for watching and for committing to a smarter, less exciting path to wealth. Don't forget to like and subscribe for more updates and deep dives into the psychology of successful investing.